Hi, this is Don Penn, Financial Planning Consultants. Tariffs, interest rates, and the economy's strength are triggering fear and market volatility. Here are the facts. Fears of a trade war with China are all over financial cable TV news, and even the Wall Street Journal is sounding an alarm. What are the facts? Assuming a trade war with China, J.P. Morgan earlier this year concluded it would result in a $125 billion tariff on $500 billion worth of imports on Chinese goods. But the impact on the $20 trillion of U.S. gross domestic product would be minuscule, shaving U.S. economic growth by just 0.1%. Frightening headlines about Fed monetary policy have widely reported that the yield curve inverted and a recession is on the horizon. But actually, the facts are not that bad. One big problem is that the media are actually reporting on the wrong yield curve. The media mistakenly reported on the differential between the U.S. Treasury 10-year bond and the U.S. Treasury 2-year note. In forecasting a recession, the Federal Reserve, which sets interest rates, says on the record that the yield curve that matters is the 10-year Treasury bond rate versus the 3-month Treasury bill, the Fed funds rate. Using that yield curve currently, the differential is 0.9%, and that's not close to an inversion. In the 2002 to 2007 expansion, after the yield curve narrowed to 1%, the recession did not start for another 3 years. In the expansion of the 1990s, after the yield curve fell to 1%, the expansion continued for 5 more years before the recession hit. The latest facts also belie worries about economic growth. November's Manufacturing Purchasing Managers Survey showed an uptick. Manufacturing is booming. Before previous recessions, this index has definitively collapsed. Nothing like that is happening now. About 86% of the U.S. economy is reflected in this monthly measure of purchasing at non-manufacturing companies, making it an important barometer of strength. The index in November hit 60.7, ticking up from October's 60.3, and is off only slightly from September's record, 61.6. New job formation was slightly lower than expected, but remained at a strong level, according to newly released data. And unemployment is near a record low. Real average hourly earnings grew by 1.1% in the 12 months through October. Real wage gains have been strong for several years. The strong economic data runs contrary to worrisome headlines that, along with the facts about tariffs and the yield curve, indicate the fearful headlines are overdone. Please contact us with any questions or to set up a meeting. And don't hesitate to share this video with people who might benefit from our work.